I should say the things have changed in some ways.
Who is the determinant of the public interest?
The more time people spend in digital worlds, the more of our lives we live there.
Intercoin, bringing power to the people. If you've been investing in the crypto markets and the stock markets in the last several years, you're probably familiar with these three scenarios. Either you come in early into a project and you make a bunch of money by buying that token or stock and eventually selling it at a profit and you're happy, or you come in towards the end of this thing and towards the top and you're holding the bag on the way down thinking, oh my goodness, when is this asset going to recover? When is the wider market going to recover and what can you do? The third scenario is when you're sitting there and everything's going sideways for a long time, nothing's really happening, and you decided, hey, let me do shorting and futures and all these things, and you get liquidated because you over leveraged. So these are the three scenarios, and typically a lot of people right now are in that second scenario. They're not over leveraged, they're just people who bought some assets and these assets have plummeted. And you're thinking, well, what can I do now? Where can I invest my money to grow my capital in a market which is just going down and there's a recession looming on the horizon? What can I do? Well, this video is for you. And I'm going to talk about the different asset classes and specifically early stage projects and startups that could potentially generate outsized returns even amid the general market downturn. So right off the bat, I'd like to say I'm not a financial advisor. If you want to actually invest in these markets, you're advised to speak to a financial professional that's in your area. My background is as a founder of several tech companies that have attracted over 10 million people in 95 different countries that help build technology to serve communities around the world. So I'm coming at it from that perspective. But I do want to talk generally about the economy and what you as an individual investor can do to perhaps make money for yourself. So take this as educational and informational and as ideas that you should bounce around in your head and think, oh, actually, that may be a strategy that I want to employ. And oh, that's what's been happening. So let's dive in. First of all, there are different time frames and eras that are essentially caused by central banks creating low interest rate environments and high interest rate environments. Central banks have the power to essentially raise the base interest rates. When the interest rates are low and credit money is flowing freely, consumers spend on their credit cards and businesses get loans. We've seen this in 2020, for example, where trillions of dollars were issued, not just by the government, they were issued by your local bank underwriters, giving your businesses a loan, like a PPP, payroll protection program loan, which was forgivable, that as long as they paid their employees, those loans got forgiven. And the banks could actually cancel the debts to each other that they had lent out. So the banking system originates a lot of the money that is then put out into the system for people to use. When that money is cheap and you don't need to spend a lot to repay the loans, in this case, the forgivable loans were free, but typically the loans were pretty low cost. And a lot of them were given to small businesses to rescue them, like the EIDL, the Economic Injury Disaster Loan, but also just private loans by banks. As long as the interest rates were low, people started deploying that money. And of course, there was the stimulus checks that people got in the mail. So people deployed them in all kinds of assets. One asset type was simply tokens, digital token. Now, those digital tokens, a lot of them, most of them, did not have any utility. I'm talking about tokens like SafeMoon or Everrise. With names like those, you would think, oh, it's going to the moon and it's safe and it's always going to rise. But where is that money coming from, right? That money is not coming from the same thing that Amazon does, which is selling to customers. It's not coming from people who are willing to part with their money in exchange for goods and services that satisfy their needs, okay? That's coming only from other speculators, the so-called greater fools in a developing economic bubble. Because what happens is that the early people who get in early into SafeMoon, for example, as a new thing, they get paid off with money that comes from later investors. SafeMoon doesn't print dollars. It doesn't originate dollars like a bank or anything like this. It just shuffles money around. This is what's known as a zero-sum game. And this is the first rule that I want you to understand, is that if there is no end customer and there is no utility for that customer, the whole thing is just essentially a zero-sum game. That means that for someone to end up with more money when they cash out of the system, somebody else has to have put that money into the system and is now going to lose it, unless a greater fool comes along and puts even more money at a bigger price in there. So if you are in the beginning of such a bubble, you're probably happy because the people who are coming after you make it seem like this is the next big thing. But if the team never develops any products and never serves any customers with that product, then essentially what you're doing is you're buying an asset in the hopes that someone else will buy the asset at a greater price. And that person has the same hope, and so on, until finally you run out of other people's money. And then when you get at the top of that bubble, one of two things can happen. Either there can be some utility developed or some sort of use for that ecosystem's token or shares of that company. It has to do something so that there is this irreversible transaction that a customer is satisfied and is not seeking later to get a refund, or it simply waits for the economy to have even more money in the system, and eventually, just through sheer inflation, some money might find its way back to your project due to some sort of new PR or news cycle or something that puts that project into the spotlight. Now, it doesn't have to be the original team that issues the tokens that also does the products and services. It could be that that token is actually adopted by an ecosystem. So, for example, that was the hope for Bitcoin. The original title of the original white paper by Satoshi Nakamoto was Bitcoin, an electronic peer-to-peer cash system. Cash system would suggest that people would actually use it in everyday transactions like cash. In other words, when you go to the store, you go ahead and pay with Bitcoin. If you hire a plumber or some kind of contractor, you pay with Bitcoin. Well, even early on, it was apparent that blockchains would not be able to support that level of adoption and usage. In fact, Bitcoin can only be used by about 10 people a second in the entire world. So if Bitcoin ever started to get mainstream adoption, the fees to actually go ahead and include your transaction in a block would skyrocket. And so to solve this problem, people devise what are known as layer 2 solutions. Layer 2s are essentially other types of networks that eventually settle on top of the Bitcoin layer. Networks like the Lightning Network. And perhaps over time, they can increase the amount of adoption. However, you need more than just scalability for adoption. You need user friendliness. You need people to be able to use something every day the way they use Facebook, Twitter, and so on. So you need a user-friendly interface. Now, in China, Korea, and many other countries, they had those kinds of revolutions. For example, WeChat in China has been adopted by pretty much every merchant there and has all but replaced cash. So if you're in China and you're going to pay a contractor or you're going to a restaurant, you can pay by simply scanning a QR code on your WeChat app. Notice what happens with WeChat, Kakao in Korea, or Line in Japan. You've also got Facebook, iMessage with Apple Pay. What happens is they're all social products first. People can communicate, collaborate, and just generally have interactions on it. And then they add payments. This is what happened with Telegram. Even Gmail has a way to pay through Gmail, believe it or not. So the first step is to actually create a user-friendly platform that people use every day. Those platforms, as you could tell, are all centralized. That's because a centralized system is able to handle all of these transactions and activity on the platform. But they do so by storing it all in one place. The problem is, of course, that a centralized platform is able to call the shots and is in full control. Twitter is in control of whether your tweet will stay on or not, if your account will even be open or not. We're talking about deplatforming. We're talking about extracting rents, charging people. And of course, these platforms are also very useful for governments, like in China, to take a look through your transactions. The US government now wants to know if you've spent more than $600, and they're able to lean on platforms like Venmo to give them that information. But let's go back. In order to have mainstream adoption, therefore, you need to look for something with a user-friendly interface. Otherwise, people will just relegate it to the province of either nerds, people who can understand the arcane dealings of wallets and signatures and Etherscan and stuff like that. Or it could be used for highly motivated people in the black market for selling drugs and stuff like that. If you want something to be used by the mainstream, like Venmo, Facebook, Twitter, and so on, it needs to have a user-friendly interface. So look for that. So that's Bitcoin and that's Dogecoin and all these things. But unfortunately, the situation got worse because many of the tokens didn't even get adopted at all beyond speculators. We're talking about Everrise, SafeMoon, and many other so-called shitcoins that were basically just bubbles of hype. They were basically memes that were propagating, and the first people to get in there made the money, and the people who bought the top were left holding the bag of the pump and dump. So as people understand that it's easy to make these tokens, they then start to understand that they shouldn't trust just random projects that don't have any utility. On the other hand, there are big companies that you could put money into. Companies like Verizon, Apple, that didn't really go down that much actually, because day in and day out, they serve people's needs for devices and internet and stuff like that, which remains fairly constant. Then there are companies that relied on advertising, which is a bit of a zero-sum game, because advertisers are essentially trying to attract customers to themselves, but away from other advertisers. And you could see this with YouTube videos where you pay to attract people from other people's videos, and they pay to attract them back to their videos. Those kinds of zero-sum games, even in the big tech sector, have been in the race to the bottom, which you could see, because you could see essentially how many ads used to be there on Google's front page of the search, or how many YouTube videos used to have one ad and now have 3 ads. They're putting up more and more ads to compensate for the falling revenue, as people realize the ROI, return on interest from these ads, is falling too. If you have a real business and you're trying to advertise it on Google or Yelp or something like this, you might quickly find that unless your advertising is super tailored and you're one of the big boys that could spend money on personalizing with AI or whatever, you're probably actually losing money on this advertising. So you've tried it, didn't work for you. You tried it somewhere, it didn't work for you. And so the entire industry is now starting to go down. You look at Google, you look at Facebook, you look at all of these companies relying on advertising, and you're seeing that perhaps this sector is in trouble too, unless they go and try something new. The other thing about these big companies, even Verizon and Apple, is how much more do they have left to grow? It's much harder to grow from a $500 billion market cap to a $1 trillion market cap, just to double, than it is for a startup company that has maybe 100 customers to go to having 200 customers. This is a big point. So if you're an investor and your objective is to see how can you actually grow your money in this environment, well, you can definitely buy treasuries. You can definitely buy bonds and corporate bonds and other things that now have higher yields. It becomes more attractive with higher interest rates. You could also consider shorting companies that you could see, like these advertising based companies, but that involves leverage. And the market could move against you, even though you might be right in the long term. But in the short term, different bull traps and bear traps where the market may temporarily go in another direction irrationally may wipe you out. But there may be something that's less risky than leverage trading and yet actually deliver returns that are far greater. And that is investing in early stage startups, companies that have a product companies that have paying customers, and companies that may be leveraging Web3 smart contracts for the kind of guarantees that you as investors just couldn't previously get before. So let's take that one at a time. Let's talk about early stage, low cap companies and stocks. First of all, they're very different than simply a meme token in that there is a team out there that is basically going to be using either the token or growing the share price because whatever they're doing seems to have worked. You have to look for a company that has an actual product, not a company that's promising to give a product. That's more risky. That's called development risk. Have they developed it? So if the product works and you get a product demo and you could play around with it, it's not a video, it actually works, not like that truck, the electric truck that goes, is filmed backwards, but actually works, and you're able to play around and you like the product. The next step would be to ask, have any customers paid for this product? That's an interesting test because the team on the startup is typically not a sales team. They are typically product people and developers and people who could maybe raise money from investors, but not necessarily the type of marketer or PR person who has a huge network of customers and they know how to sell. So if they're able to sell their product, that's a good sign because then you could recruit a bunch of experienced sales companies that work on commission or whatever and are able to move product even better than the founders themselves. So if the founders, not being salespeople, are able to sell the product for, especially if they're able to sell the product for high ticket prices like $10,000 to $50,000, and they can do this repeatedly, then you know they can sell it for smaller price points and they can develop something for the long tail. But you know there's something there. Examples include Uber, which started out as a high-end driving company, and the slogan was everybody's personal driver, everyone's personal driver, the black car, the person in the suit, right? So then they became mass market later on because of Lyft and all that competition. But to know that people are willing to pay for that high-end experience and the experience exists and there's a technology, an interface that's easy to use, those are the types of things you should look for. Now, be careful. Make sure that the customers are not just friends and family of this of the founding team. Wait a little while. Wait 1 or 2 months and make sure that they can close some more customers. You should be able to see how the sales is proceeding and ideally even get testimonials from the customers. It's okay for the customers not to be totally happy. It's okay for them to complain. The fact that the customer parted with their money and was willing to spend money, especially tens of thousands of dollars lifetime customer value, maybe not upfront, maybe over time, but that is a signal that there is something there. There's a need that the customer needs to fill. There's an itch that needs to be scratched. And the idea is that if the founders are able to find randomly a bunch of customers like this, the market must be, there must be a lot of those out there. And so that's the opportunity. Now let's compare early stage startups to later stage companies. If you're coming into a later stage company, say a company that makes already $10 million in recurring annual revenue, ARR, if they are making that kind of money, first of all, you're not getting a great deal because they can go to a bank. Those are the kinds of things that banks fund. If it's repeatable revenue and they've shown it can be done, a bank can just give them a loan. And if they're doing well, they'd rather pay the interest on that loan, even at these rates, than give up a percentage of their future revenues. Why would they do that? So that's one thing, is that you're already not getting as good a deal as if you came in early, but not so early that there's not a product and there's not any paying customer. However, a bigger thing is that for that company to grow, it needs to now deal with the wider market, because it's easy to find the next 100 customers in the entire world. And even if on average, statistically, people are losing money and there's not as many customers as there used to be, we're talking about millions of customers. And here you only have to find 100 or 200. That's huge. In other words, you actually have more risk with the large company in that the company has already reached the capacity that the world or its environment is trying to present to it. It's already found the demand and is now trying to eke out different efficiencies, maybe cut staff, maybe do things. Whereas the early stage startup is essentially for its shares or tokens to grow. All it has to do is attract more customers and then get more press, which will then attract more investors like yourself to a product. And unlike the token project, there's an actual team and an actual product and a proven track record of customers who are willing to part with that money. Now, as an investor, you might want to get testimonials from these clients. And again, these could be videos, but you got to make sure that they're not friends and family only, that these include other customers. Perhaps if you really want to check, you should get involved and try to sell this thing yourself, or have some of your friends try to sell it to your associates. In other words, you don't have to bring other investors, but try to see, like the founders, other customers. In fact, you can offer the founders to be a salesperson. They'll give you the prospects and then you try to close them. If you see that it's easy to close for this product, or it's relatively easy compared to, say, selling, a juice blender nobody needs, that's a huge signal. So perhaps one of the best ways to do your due diligence is to actually be a salesperson for that very product yourself, and help refine the sales process. See why people are saying no. So if you see that you can actually plug some of these holes, and each of these holes, keep in mind, are multiplying and compounding. So for example, if you lose 10% of the people because of some hard to find link on the front page, and you fix that, suddenly that's 10% more people going to the second page. And once they reach the page where they pay, then essentially now you got the money. And then you reduce the amount of people asking for their money back and dissatisfied customers. So you can think of the sales funnel, if you will, from beginning to end, from when people discover your product, ideally from other people. You look at this funnel, and every step you break it down and you see, what is the conversion? What steps does a customer have to go through? Each of these is, you're losing some people. There's some attrition. You end up not with 100% conversion, but 90% conversion. And so you look at where you can improve the conversion, where you get the most drop off. Let's say here you're losing 80% of your people. That's the place where you could deliver the most value as an investor turned sales consultant. And perhaps you should have sales consultants that are experienced, that are working with you. So you discover the founding team, and the sales consultant then comes in and helps. That's what you might want to spend your money on, because the founding team probably doesn't have the money to try to spend on this very important optimization. So by doing that, not only do you help the team and make them like you and give you a better deal, but you've also made a diamond, you found a diamond in the rough, and then you help to polish it off before anyone else took notice of it. And then, of course, once you do this, then you get more customers, you get more customer growth, you can then get stories. So that's the other type of partnership, and that is with PR, right? So once you get the sales going, and then you get some satisfied customers and you have them record testimonials, the very next thing is you actually try to get stories printed in these journals. And again, that's based on relationships. So these journalists already know, sources that they were willing to listen to and pick up the phone on, or read their email and check out the products. You can also go to things like Product Hunt and companies that essentially help to leverage their network to, Kickstarter, Product Hunt, and so on, to boost things to the top. It's just the way these things work. Organically, you're not likely to get anything to the top of a big Reddit forum or anything like this. You do need to have essentially partnerships to game the system, because unfortunately that is how it all works. Social capital is something you need to amass, okay? It's not an accident that a YouTube video gets 1 million views. It's because they've been building that over the years, and they have a lot of social capital and real capital and partnerships in place. So again, you need that. And if you're an investor who's investing in early stage startups, ideally, if you don't have this network of PR people, of boosting things on YouTube or Instagram or whatever it is for this product that needs to be, attracting customers to the top of the funnel. And if you don't have people who are optimizing this funnel in repeatable ways and are able to come in there and do copywriting, which can now be done and optimized also with AI, and also A/B tested. If you're not doing these things and all you're doing is investing and giving your money to the founding team and hoping that they will do it, you're leaving a lot of money on the table. And remember, this is multiplication. This is exponential. Every time you improve a conversion rate from 20% to 40%, you have just doubled the bottom line. So there's plenty of opportunities for you to come and find inefficiencies in a startup and then come with your partners and pay those partners so the founding team doesn't have to pay them, and have those partners have as little that they need from the founding team as possible, so they can come in there, they can analyze everything, they can be self-directed and produce as many recommendations as they can, and then they can work with the founding team and essentially the developers to just integrate these suggestions. So you as an investor, your alpha, so to speak, in the startup space could be partnering with both the sales and the PR in order to remove inefficiencies in the sales funnel and then drive people to that sales funnel. And the most powerful thing is if you can make the product viral, which means that current customers or freemium model customers who aren't paying anything can then keep inviting more people and getting rewarded, for example, with tokens and credits that they can use within the system rather than paying. If you can get that, then you might not even need to spend any money on what is known as advertising or marketing. Notice I mentioned sales and PR rather than advertising and marketing, because like I said, advertising is a zero-sum game where one store A says, please come to us instead of store B, and store B says, please come to us instead of store A, and at the end, the platform on which you're advertising gets their money. I'm talking about where each project and each system is not just self-sustaining, but can grow exponentially. If you can get the viral factor above 1, you don't have to spend any money on marketing because you will get an exponential curve. How steep that exponential curve will be is just a matter of time, as long as the parameters remain the same. That means if the first 10 people behave in a certain way that the average person invites, say, 2 other people in the first month, that means after a month, that user base doubles. And that's the same for the forum, and that's the same also for the AMAs and the YouTube channel, everything else. In other words, what you would like to do ideally is to create a repeatable, viral loop in that new people go through the same onboarding process and the same sales funnel, and they become a client, not necessarily a paying client yet, but someone who's motivated to bring on other people. So perhaps one of the ideal products is a product that either serves a community, so a community leader comes in there and then invites all of their remaining community in there. And then some people in that community happen to be involved with other communities. They may be leaders themselves, they may be other people who are staff, and then they'll go ahead and bring other communities. These are called super connectors. So in fact, you can even optimize to find startups who are serving the super connector. They're giving them the tools to connect with their community and to get something done. That super connector typically struggles with engaging their community, with finding relevant, interesting things and events for them to do. And also for that super connector, instead of having to do all the work, would like their members to have a hand in planning the events, connecting online, and just in general, connecting with each other over common interests without requiring the central planning of that person. Any startup that gives tools to these super connectors can be described as B to B to C. In other words, business to consumer. Now you may say, yes, but these businesses, even the small businesses, are sometimes bureaucratic and they won't just take on a new SaaS, a software as a service model. And you'd be right. Sometimes there could be an even more powerful thing. You could have a startup which takes a lone teacher or yoga teacher or instructor or any sort of leader, and who doesn't really have an organization, a bureaucratic organization like a school or university or whatever enterprise sales you normally have to do. Just the individual who decides that they would like to have a tool to manage what they're doing. And then that individual, your tool helps them to become a business and incorporate a business around what they're doing. So in other words, you invest in tools that help turn consumers, which is teachers, whatever, into businesses. And then it's essentially You are helping build the very business that will then give you recurring revenue. So compare that with regular investing. Regular investing is passive. It's a little bit lazy in that you could just hear a stock tip or something, go ahead and just pop on some sort of app and go buy that thing and you're done. But of course, if you're lazy, you're doing and you're getting everything else is doing and getting. It's all been priced in. That's why if you're competing in the public markets, you're essentially competing in a zero-sum game where the money is just being shuffled around. In other words, for someone to win and get more money, someone else, another investor, has to come in and have put that money in. So if they pull their money out later, let's say when everything went down, they've actually lost. So the people that actually lose are typically the people who buy the top or the people who sell the bottom. Or the people who are the biggest losers are typically the ones who leverage and they do things like futures trading. If you've ever done this, you've probably been liquidated a bunch of times, or maybe slightly safer is options. But then again, these options rarely pan out exactly the way you expect. And if you sell these options, you might be on the hook for a massive loss. So instead of leverage, instead of trying to eke out success in sideways markets where you're picking up pennies in front of a locomotive, consider that there is a reliable, repeatable model that not everyone uses. Consider that instead of competing with an entire world of investors, including hedge funds with high-speed trading and short time scales, that will outtrade you on short time scales and get in there and snipe things before you, or the long-term trading with wealth management that employs lots of quants and analysts that look at fundamentals of companies and analyze news and trends that are coming down the pike. Rather than having to compete with these companies that clearly are chosen by large wealth management family offices and investors for a reason. It's because they're going to take your money, and 5% of the participants on the markets take the other 95% money over time. It's like being in a casino where you could win short term, but eventually the house it always wins, right, in the end. How about your alpha? In other words, your advantage over the global market is that you don't compete with the global market. You happen to find, whether it's on the internet or locally or through friends, startups, early stage companies that have built something that people are willing to pay for. That's better than tokens because it's not a zero-sum game. It's not a bubble. It's something where the money's coming from customers. You could make a bubble on top of it by hyping the thing, that it will serve customers in the future and extrapolating these curves and these growth curves. You could do that, but you could also actually have an Excel spreadsheet and a model that will demonstrate those things, and you could actually have partners to optimize those things. So like I've said, if you come in and you help these founders focus on what they do best, which is building the product, and you come in with people who can optimize their sales funnel, do their copywriting, and in general, A/B test more and more successful conversion funnels for them. And if you can then do PR for them and get more and more stories printed, and if you can arrange all of this with them to form viral loops, then you're literally creating value where previously there wasn't any. And that is not necessarily a zero-sum game. At least it's not a type of zero-sum game on the short term that you would get in the stock market. Your advantage is that you're unearthing new diamonds. You're digging up more gold that no one ever saw before. Yes, the gold was there. Yes, the ideas were going to be done by someone, but they're going to be done by you. You had an active hand in growing the business side of what these founders have done. They have done the product, they have done the development, and you are going to take it to the next level. You could actually be helping society by creating efficiencies and products that serve people's needs, whether that's for entertainment, which is just to entertain people, or whether that's for actual utility and actually helping people connect with their kids or their parents, or maybe helping them eat better or be healthier or whatever. That technology and science is what drives society forward. Now let's talk about the type of startup that you might want to look at. I've already talked about a startup that has a user-friendly interface, targets specifically community leaders that are able to bring a lot of people into the super connectors, and then empowers these super connectors to go from being a simple decision maker a single person to essentially creating an organization around themselves where they are in charge on their own. They're the king of their own domain. You give them their own app and their own domain. You can help turn any startup into this type of thing and then get PR and everything else. You're essentially a co-founder, if you will, okay? And you can get a lot of money over the next several years. Now, again, you have to make sure that the product exists. You have to make sure that people are willing to pay for it. You have to insert yourself in the sales process and spend your own money, but that money that you're spending can actually help the business start to grow exponentially. And at that point, you can hand it over to the venture capital, the private equity firms, and even banks that you can also have partners to finance alongside you. So let's talk about what other elements can help you to guarantee that your investment doesn't suffer the kinds of things that people historically have been burned by. Things like, for example, printing more shares and diluting your ownership down to whatever through other rounds, down rounds, and things like that. Normally in the past, people had to rely on legal systems and jurisdictions that are reliable, like the United States, for specifically the state of Delaware for startups, or Singapore and stuff like that, and Asia and so on. Those jurisdictions and legal systems gave investors what at the time was the best they could hope for, which is legal recourse in case something goes wrong. They can go and bring suit in a court, which is typically user friendly to investors and corporate business. However, today with Web3, we could do better. We could have smart contracts almost absolutely guarantee practically that certain conditions would be enforced and certain risks would be eliminated. What kind of risks are we talking about? Well, there's a wide variety of risks that can now be guaranteed pretty much to be eliminated using smart contracts that are currently running on blockchains like Ethereum. One thing you can guarantee is that these smart contracts will execute exactly the code that they are written to execute. Now, you might think that was the case the whole time. As you were using Web 2, you were relying on Facebook, for example, to enforce your privacy settings. You were relying on Facebook to show your tweets or show your posts to your friends. You're relying on Twitter to surface your tweets. Of course, if you see, most of these platforms don't necessarily do what you want them to do. They might deplatform you. They might not promote your tweets. They might show tweets of other people more than yours and so on. And so already, even large organizations, let alone the small ones, would be frustrated to know that, they're not doing what I want, but this is the only thing that exists, so I have to use them and I have to pay them money to advertise, and that's how they made money. But with smart contracts, anyone can deploy essentially a smart contract. And that allows anyone to build a business and collect money globally. So there was a time before the web when people had to rely on radio stations and TV stations and newspapers and magazines to get their message out. We're talking about content that they wanted the world to see. But they didn't have that kind of wide circulation. Even if they got in a newspaper, the circulation was local. If they got into a radio show, only one thing could play at a time. And so not only that, but it would only reach a local audience because the radio waves would not be syndicated around the whole world. But with the advent of the internet, new protocols started to emerge, open, permissionless protocols that allowed people to essentially take advantage of what was previously available only to people who owned closed networks. Protocols like email allowed people to send messages around the world, not just in their local university, but to universities halfway around the globe. Similarly, the web, on an open protocol called HTTP, started to reach anyone with a web browser. If you fast forward to today, every device that consumers buy, whether it's a computer or a phone, has a web browser built into it. So the web browser has become a ubiquitous platform that's the most widely deployed thing. And HTTP, an open protocol, has allowed companies like Facebook, Amazon, and Google to be formed and to serve essentially so many people that they became the largest stocks on the stock market, the most highly capitalized stocks. So, of course, you could see the patterns here. You could see that technology helps to create efficiencies. And now with AI, that could become even more exacerbated. One Facebook engineer is needed to essentially serve 1 million customers. So these companies become more efficient over time. Tech is great, but the efficiencies created by the Web3 smart contracts allow you and investors at large to trust their money to these smart contracts. There's a very big difference between putting your money in centralized exchanges or companies like Celsius, which will offer you some yield, or Gemini or Binance even, or Coinbase. These are considered reliable centralized entities because they're overseen by government. But we've seen time and time again, one or another thing lead to essentially the undermining of what we previously thought we could rely on. We've seen, for example, the implosion of FTX, right? A huge one. But we can also see privately controlled platforms like Twitter with Elon Musk or Facebook with Mark Zuckerberg. We see that these platforms don't really belong to the people. They belong to the shareholders of Facebook, or in this case, Twitter. What we'd like to do is talk about how platforms that are run by the people, not just for the people, can actually help to improve trust. So Ethereum, for example, is a platform that is run by thousands of computers around the world that are all running the smart contract code every block and verifying, making sure that that code is exactly what does exactly what it says it's going to do. So one type of uncertainty is eliminated, and that is we know how much capital there is in a certain smart contract. We know what the balance is of every account, and we know what the code is and what it's going to do. There is one huge exception that I need to warn everyone about. Because Ethereum allowed anyone to create a smart contract, it also allowed creation of smart contracts very easily that have backdoors and sometimes simply bugs that cost people millions of dollars. We've seen this not just with bridges between blockchains, which are very vulnerable, but also with essentially custom smart contracts. Most of the meme coins and the fads that people invested in were built, each of them, on an individual smart contract. And that smart contract was, in fact, custom. This is very, very dangerous and inefficient because who knows? You're not a developer. And even if you were, would you be able to catch that on line 235, there is a backdoor that says on this date, change the contract behavior and start funneling all the money to this address, right? Even projects like Hex did not initially disclose that they had an origin address, and people simply had to look at the code to discover that they in fact had an address that was receiving a lot of the money. Now, you could say that's a desirable part of the system, and the people that tend to stay in that project, Hexicans, like the idea of one giant whale that's able to essentially wield some sort of outsized influence on the ecosystem. Be that as it may, that was a custom smart contract. And my point is that there are a lot of other projects that people trust day in and day out, but don't realize why it is that they trust those and get rug pulled by others. The reason that some projects are completely trustworthy is because they and their smart contracts are being produced by smart contract factories. Smart contract factories are simply smart contracts themselves that can produce instances based on a template. In other words, these instances all have the same basic code and only differ in their parameters. For example, Uniswap pools only differ in how much is the initial liquidity and what is the token pair, which two assets are they trading. Similarly, on other more complex exchanges like Curve, there can be multiple sets of assets that are being traded all at once, not just in a pair. But the idea is that all of these liquidity pools have exactly the same code, and it's been audited by many different companies, and it's been battle tested over the years by people putting real money and having absolutely zero exploits over time. So can we 100% guarantee there are no bugs? No, perhaps one day a bug will finally be discovered. But having so many people battle test and put money into it and so on, is a much better guarantee that your liquidity pool, that is like every other liquidity pool, is going to do what it says it's going to do. So this enables marketplaces like Uniswap or Aave, which is a lending marketplace that brings together lenders and borrowers. It allows these marketplaces to operate with pretty much 100% trust in both the underlying network, which is run by Ethereum, let's say ecosystem, and into a smart contract, which is then running on top of that, which is the software. Intercoin, our company, helps to build the kind of software that communities can then put their trust in. And we're going to be the first ones to say that our software needs to be vetted, needs to be audited, and then battle tested by more and more communities. So it could be that version 1, just like version 1 of Uniswap, okay, may have some inefficiencies and improvements, and indeed even bugs that people could discover. So people might lose money due to a bug that was discovered, just like they did with Ethereum Classic and so on. But then people come in with version 2, and we're planning to fix those bugs as a team, and then the open source with a wider ecosystem can contribute bug fixes on GitHub to us. And together, we can create version 2 of the smart contract. And as more and more of these are fixed, what you get is a more and more resilient system. Just like Linux, just like Nginx and Apache web server, and all these open source building blocks that are now power the web and the internet and all these things that we rely on every day. Just like those things, we are building an ecosystem, an open source ecosystem that the entire world can rely on. And the difference between that ecosystem and the closed source one of banks and closed exchanges and closed platforms with their server farms that store all your data, and you just have to trust them, the difference is huge. People who think that Web3 is just about Ponzi schemes and grift don't understand that there is a fundamental shift in technological ability and opportunity to create real code that serves the public. We already see open protocols like Uniswap, which launched, I think, in 2019, like Aave Marketplace, and many others that people rely on. They don't realize, but they rely on it because it's built on a factory model. Factories produce instances that are all the same. So don't invest in smart contracts that are one-offs because you don't know what they're going to do, but you can and should be able to trust smart contracts that have been produced by factories. And the more people use those factories, the more trust you can have in this type of thing. So if you see a factory that more and more communities and investors are putting their money into, then you could see that this is the new thing. This is eliminating the intermediaries. It's disintermediating these things that centralize power in the hands of a few people like Elon or Zuck or SBF and even, to be honest, CZ or myself. It's essentially, if Vitalik Buterin, for example, does something crazy, it's not going to really kill Ethereum. You can assassinate, God forbid, Vitalik, and nothing would happen to Ethereum, because that's the point of a network that's owned by the community and is not necessarily controlled by any one person. So that's huge, and that's because when you want to accumulate liquidity and trust in one place, you want to make sure that the governance of that one place and the layer one solution that is powering that ecosystem is as secure as possible. And the security actually is improved drastically, majorly, by disseminating the power between all these nodes, so that as long as 33 or more % of the nodes are honest, everything works. I'm sorry, I said it the wrong way. As long as at least 67% of the nodes are honest, everything works. The system can even be designed to be reliable in the face of if 99% of the nodes are corrupted. It just wouldn't be able to make further progress until you remove the corruption and continue. So this is the type of technology that can be done. It's not just blockchain. We're building Intercloud, which is a blockchain killer, you could say. That's the subject of another video. where it's more scalable and is actually going to be able to power the types of decentralized applications that blockchain proponents claim the blockchain will be able to do. Remember, the whole crypto space was supposed to have started with Satoshi and Bitcoin as a reaction to banks and the financial system just printing money, being able to just issue as much money into the system as they wanted to collectively, right? And the voters voting themselves more money and whatever. But while Bitcoin and Ethereum and these decentralized projects, including Dogecoin and even including Uniswap and all these, as it made it easier and easier to set up these exchanges, and people started betting with this mania on these bubbles and these zero-sum games of shuffling money around, you got, again, this idea that you're going to put your money into an exchange and beat someone else and take their money like in a casino game, or that you're going to deploy your money into Celsius and you're going to get a yield that you rely on this other company to do. And so these companies sprang up again to manage your money, similar to banks, and they made those banks from 2007 and 6 and all that collapse seem like very, very responsible stewards of pension funds, because the very industry that was reacting to the banks doing it led to essentially even more unaccountable centers of money. But you with your wallet and your private keys can opt out anytime you want. Just take your money off the exchanges. Take your money out of the centralized lending companies that promise that they'll give you a yield. Where's that yield going to come from? So you put it back in your wallet and you make sure that your keys are secure. The way you make sure your keys are secure without any technology whatsoever is that you simply write down your 12-word phrase of a new pristine wallet. Of course, you have to trust the wallet maker, right, that gives you the phrase. But basically, you could come up with your own phrase even, and then you could create 3 copies of that phrase, 12 words, and cut up those copies into groups of 4. So that's 9. So that's 3 copies. Each copy is then cut into 3 strips. And then just take those 3 strips and put them in different places, maybe your freezer, maybe buried in your backyard. Now that I mentioned it, you should try some other things. Only you know where those 3 pieces are. And if one of them gets lost, well, you have 2 other backup copies of each thing. So it's not really hard to make sure that your secret key is safe and you can find it when you need. This is for large balances, okay? And again, as long as you have that private key, as long as you have that 12-word phrase, you can generate a private key from that. And so you could even come up with your own 12-word phrase. It's just a bunch of words drawn from a lexicon. You don't even have to trust the wallet to come up with one for you. And then just write them down, put them there, and just make sure that you can use some offline software like a program that you download from the internet, like Node.js code. You can look at that code. It's not that hard. Use it as a library to turn your 12-word mnemonic phrase into a private key. And then you could just go ahead and sign locally with that program, disconnect from the internet and sign whatever you want with that private key, and then go ahead and see if that works. Post it to the blockchain. If it works, there you go. You've got your seed phrase. And if you ever need to move large amounts of money, now you know how to do it. You only needed to use that private key once. My point is not about private key management here and custodianship. My point is simply that if you are going to participate in the crypto ecosystem, understand the strengths it gives you. It gives you self-sovereignty over your own funds. It lets you be deciding how to safeguard your keys as opposed to being forced to give it over to your bank and maybe have your bank garnish your wages or whatever the government tells them to do. Maybe in the United States and Canada, maybe you agree with the democratic governments. But if you're living in a country where you might not agree, then stop giving your money to third parties. Invest your money how you want. And so if that is the case and you have some crypto, consider projects, perhaps like our own, indeed, Intercoin, to invest in that, like I said, fit the criteria of having a product, having a team that knows how to improve the product and is willing to work with your sales team, willing to build a sales funnel, and willing to work with your PR team to get a cohesive story out there. You could be a founder in your own right. Don't just be a lazy investor looking for how to passively invest in the stock market, because guess what? That stock's going to go down because you're competing with people around the world. Hedgies are going to take your money, okay? Stop over leveraging. Stop doing all these things. I did it. I got wiped out many times. I had Bitcoin back in 2012, I think, or 13, okay? And I discovered Bitfinex. Don't do that. How about you go ahead and find startups? It's very easy for them to grow 200%, 1,000%, much easier than for Apple or some company that's already publicly traded. Stop competing with the rest of the world and discover smart contracts, discover smart startups and founders and help them and and you know what? You should have partners like Intercoin. Indeed, contact us. We could help you with the smart contracts that are vetted and take away the type of risk that you're facing whenever you simply rely on the founding team and their cap table management company and hope that, maybe later you'll sue them. Look at what's happening with the people that had to sue Mt. Gox or FTX and the bankruptcy proceedings. Is that what you want? So keep your own money and invest globally in so many projects. And we have a company that we are looking to promote soon. We're putting it together in Singapore called Unblockers, which will take care of all the other types of risks that investors face. Again, crypto doesn't have to be the Wild West with factories and with actually smart contracts that do what they say they're going to do. We can get all the things done with DAOs and all these things and collective governance that are owned by the people, eventually by the public, and everybody wins. So if you like what you hear, join our community and let's talk. Thank you. Like to be the first to hear about Intercoin's roadmap and news? Definitely join and subscribe to the channel. Don't forget to click that little notification button so you can get updates when the next video drops and the next time we interview a legend like Noam Chomsky or Patrick Friedman. And if you would like to participate in the conversation, go to community.intercoin.app. We'd love to hear from you and about your community. This is what the project is all about. Intercoin, bringing power to the people.